speaker this evening is Zaheer Anwari, co-founder of Sublime Trading. He helps CEOs and high net worth individuals get consistent returns in stock markets using a proven strategy in just 60 minutes a week. Zaheer will tell us more about this. Over to you, Zaheer.
Okay, so today I'd like to break down a process that I believe should take center stage in each and every one of your investment portfolios, maximizing your investment potential through a trend-based approach. So first and foremost, I'd like to start with the numbers. So this is a compound calculator that we've created at Sublime Trading. So if you all have an initial investment of £20,000, this is what I recommend everyone should really start with. And if the goal after 20 years is to reach £1 million and you have a monthly contribution of £100 to this total, you're looking at an annual return of 19.78% each year over 20 years. It's very achievable. Now that we've got the numbers, we can reverse engineer this process. So first of all, if we look at the banking system, it's giving you less than 1% a year, so we can ignore that. S&P 500 tracker fund, typically 7% to 9%, maybe 11% a year, depending on which tracker fund you go with. Hedge funds, 5% to 15% a year. The challenge, of course, is finding a good hedge fund. Last year, a lot of them didn't have a very good year. Real estate, 10% to 11% a year. Real estate, people are always interested in it. I have one property, it's not a big part of what I do. But, if you have a portfolio, real estate does return you good returns. Wine, we're looking at this 13 to 14% a year over the last 15 years. Pretty interesting alternative investment. But trending stocks will get you over 30% per annum over the last 10 plus years. So if we look at the 19.78% you want to achieve, there's only really one winner here. And that's really where I focused all my wealth and my returns over the last 10, 20 odd years that I've been doing this. Okay, so some proof. 2020 to 2021, I've got a broker account which I funded with £65,000. At the end of 2021, just over £122,000 in the account. So an 86% return in 18 months. In the UK, this was tax-free, as we have spread betting accounts. So a reason to explore spread betting accounts, which have a bad reputation, unfortunately, but they are powerful broker accounts. Last year, 2022, of course, we had the decline in the stock market, 28% decline in the S&P 500. Our fund, which was the first year we started managing funds, we had just under 6% loss. So what I want to show you guys here is that in periods of boom, maximize your returns. In declines in the market, curb your losses. And this is all down to risk management. It's essential. Okay, so what is a trend? The definition, the general direction in which something is developing, the general direction. So we're thinking long-term, not short-term, long-term, the general direction in which something is developing. So if we look at what is a trend in the market, well, we've got bull trends, where the market goes up, bear trends, where the markets go down. And then there's also a sideways market, which is known as a consolidation. Don't ignore consolidations because they're powerful. And I don't mean trade consolidations. I mean, understand that they're happening and how to use them. And we're going to go through this today. Now, typically, bull trends and bear trends in the market, they last 12 to 24 months before there's some kind of correction. Here's a fact. Bull and bear trends are the two most profitable periods in the market. That's a fact. Day traders will tell you otherwise. I beg to differ. Okay, bull and bear trends are the two most profitable periods in the market. And that's what we want to really focus on. Okay, so here's a quick table. And I want to look at this bottom period here. I've gone back to 1990. Since 1990, there have been around 23 years of bull markets. I say question mark because we're in 2023. Is it going to be a bull market, bear market, sideways market? We don't know. But 23 years since 1990, 4 years of bear markets and 6 years of sideways markets. So bull markets and sideways markets is really where we want to focus on. If a bear market appears, we have to be able to switch our stance. Now, there is another variable, sectors. There are 10 sectors in the stock market. And this is really important to understand. It's often something that's overlooked by retail traders. We have to understand sectors. The reason for that is because there's a general flow of money between the sectors. Money flows between the sectors every 12 to 24 months. There's some kind of rotation. So if we can identify where the money is in terms of which sectors, we can focus on those sectors and then take our profit and go back to the beginning looking for those sectors again. Now, think like a falcon. I understand in Dubai, the falcon is the traditional bird here. Guys, we have to think like falcons. And what I mean by that is a falcon will soar, look down, see its food, go eat, go back up again, and repeat the process. That's how you want to be looking at sectors. You're like a falcon looking down, look for the money, go feed, go back up, and rinse and repeat. Just a quick background of the sectors that we've invested in over the years, just to show you guys the sort of rotation that can happen. Notice in 2018, which was a sideways market, we actually moved to currencies. And the US dollar Turkish lira performed very well for us that month. The red period is Corona, when we were dealing with that towards the end of 2019 into 2020. Notice that when the correction and the reversal back into the bull market came in, the sectors stayed the same. So generally what's happening before a black swan event is what happens after a black swan event. Nothing really changes once it gets absorbed into the market. This year, what am I looking at? Consumer discretionary, financial materials, they're all looking interesting. They're opportunities presenting themselves. And I'm going to be explaining how I do that. Now listen, guys, don't get it twisted. The odds are not stacked in your favor at all. Ultimately, the markets are designed to take money away from the retail trader. But what we have to do is understand that institutions think us retail traders are the dumb money. They call themselves the smart money. So what we need to do is think like the smart money. And what I mean by that is we have to align with the smart money, get them to do all the hard work, and piggyback the ride. Let them create the trends, we ride the trends. So here's an example. What I mean by this is let the institutions do the hard work. We just need to identify the start of these trends, enter our positions, piggyback the ride. It's simple, it's smart, and it's very profitable. This is a stock that moved up 50% in 2022 when the S&P 500 declined 28%. This is McKesson Corporation, US stock. It's in the healthcare sector. Now, how do you align yourself with the market? Well, let the market lead and you follow. Let the market dictate and you follow. Don't try and fight the market. Align yourself with the market. This is something I try and really repeat again and again and again. Often investing is seen as a battle. Particularly day traders, they feel like they've got to take on the market. Guys, you'll lose. Align with the market. Let the market do the work and follow. So how do we do this? Well, there's 3 C's: clarity, control, and consistency. These 3 C's, there's a sweet spot in the middle. If you can get all 3 of these together, that's where the money is. If one of these elements is missing, people will struggle. So let's break each of these down. The 3-step blueprint. Step 1, clarity in when to be in the market. Step 2, control over what assets to have on your shortlist, ones that you're watching. And step 3, consistency in maximizing profit during market trends. Right? That's all it is. When to be in the market, what to buy, and how to extract profit. That's ultimately what investing is. It doesn't have to be any more complicated than that. So step 1, clarity in when to be in the market. Use the S&P 500. Why the S&P 500? Well, the S&P 500 is a major US index. Other indices tend to follow. So whatever the S&P 500 is doing, all other indices, including, say, for example, the FTSE, the Nifty in India, they all tend to follow whatever the S&P 500 is doing. So if we can look at one index, let the rest follow. It's an average of 500 leading US public traded companies. It's an average, guys. So it's telling us on average what the market is doing. Because of its depth and diversity of stocks, it's widely considered as the best gauge of the entire equities market. So if stocks in general in the S&P 500 are moving up, the stock market is bullish. If stocks are moving down in general, the market is bearish. A mixture of stocks moving up and down, we're in a sideways market. So this makes the S&P 500 the perfect barometer of what the stock market is doing. If the pressure overall is bullish, let's go up. Down, bearish, neutral, we stand aside. Again, that's really important. Standing aside is a position. Okay, so how to use the S&P 500. Look at price in relation to the 200 simple moving average. I'll explain what that is in a second. On both the weekly and daily time frames, the 200 SMA is a proven and timeless indicator of the long-term trend. Now, here's a quick history lesson, guys. Why the 200 SMA? Old school traders used to draw charts by hand. So they were very, very particular with the information they put on their charts. The 200 SMA proved to be a proven indicator of the long-term trend. So the 200 SMA does what the name suggests. It gives you an average of price every 200 days. So if a stock is trading above the average, it's bullish. Below the average, it's bearish. Now, how do we use this? Well, look, in a bull market, we want to see price above the daily and weekly 200 SMAs. Example, 2020 to 2021. Price was trading above the 200 SMAs on the S&P 500. 2007 to 2009, we were in a bear market. Price was trading below the 200 SMA during those years. And then, of course, we have these sideways markets. Now, this is the thing. 2022 was an interesting year. If you listen to the news was telling us we're in a hell of a crash. But if you focus on the charts, you'll know that price never broke below the weekly 200 SMA. So we never entered a bear market according to the stock market. According to the news, hey, a whole different ball game. Ignore the news, focus on the charts. Charts are a source of truth. Okay, so this should now, going back to this table, this should now make sense to you guys. I've calculated this simply using the 200 SMA. So if price is above the 200 SMAs, we've been in a bull market. And that's happened for the last 23 odd years since 1990. It shows you how powerful the 200 SMA is. Okay, so once the SMA has confirmed, once the S&P 500 has confirmed a bull or a bear market, we then scan the market for opportunities. So what does this mean? Well, the S&P 500, as I've already said, is an average. Some stocks will match the average, so you'll get average returns. Some will underperform. You don't want to be in these stocks. But some stocks will outperform the average. These are the stocks you want to be investing in. That's how you exceed the average returns of the S&P 500. You switch it in a bear market. Look for stocks weakening quicker than the S&P 500. So in 2000 to 2002, 2007, 2009, if you picked the right stocks, you would have had a very good year if you shorted the market. This is where value investing will get you in trouble. Okay, now important, investing is not about buying and holding forever. It's another fallacy people buy into. Hold stocks when trending, exit stocks when reversing. Move between the cycles of trends across sectors. Rebalance every 12 to 24 months. This is a really, really important point. Every 12 to 24 months, take your profit, go back to the beginning. Comparative returns, guys. Quick example of the difference of what you can achieve. If your initial investment is £20,000, so we've got the S&P 500 tracker fund, which is your average performance. And if you can find stocks that are outperforming the average, let's say you start with £20,000 in both, you invest for 20 years, $100 each month, additional contribution. Right, these are the average annual returns you can expect. S&P 500 will give you 11%. Individual stocks outperforming the average will get you 30%. This is what you'll get with an S&P 500 tracker fund. This is what you will get investing in individual stocks. So it's worth spending a little bit of time understanding how to do this. Don't listen to S&P 500 tracker fund guys on LinkedIn telling you guys are just better than average and no one can do this. You want to learn how to do this. Because not only is the difference massive, the skill that you learn, who's going to teach your kids? The schooling system's not going to do it. Someone has to take control, break this loop, this financial illiteracy loop we're consistently kept in. Someone has to break that. And that's what your reward will be. Okay, so how do you shortlist the very best stocks? Control over what assets to have on your shortlist. This is step 2. So we had clarity, now we've got control. You need a filtration system that goes from 10,000 stocks down to 10 to 20. And those 10 to 20 are the ones that you watch. First of all, you need scanners. We pay around £350 a month for scanners so we can do this process. We go from 10,000 to an initial shortlist, depending on markets, 50 to 500 assets. We then take those 50 to 500 assets and we do a manual filtration using tools that we have developed, charting tools. And I do this process every day. And that's how I'm always picking out the best 10 to 20 stocks. And I do this for my community members. It takes me an hour each day, 2 hours each day, and I'm paying the £350 a month so they don't have to. I'm saving them a lot of time, a lot of money. Okay, preparation starts at the weekend, but we do this daily. Now, this is my checklist system. I have 6 indicators on the monthly, 4 on the weekly, 6 on the daily. When all of these indicators are met, I take a position. If the indicators aren't met, I don't take a position. This is what my checklist looks like. Now, there's terms on there you won't understand, but I'm going to show you a simplified version of this. But ultimately, you want to have a checklist system. And here is why, guys. There are 2 big problems you need to solve. One, you're up against the market. 2, you're up against yourself. And arguably, the second is more challenging. So you're often your worst own enemy, not the markets. So here is the other thing, guys. There's 16 investor biases that will kill your performance. And at any moment in time, you're dealing with 4 of these. So if you can have a checklist system that kills that, and by adopting a proven edge and using a checklist system, you negate these biases. You depersonalize the process. How many times people lose positions and think the market's got something against them? Don't. It's just a bad process. It's not a personal process. Force yourself to focus on market structure and high probability setup. This is the investor mindset. Checklist is met, high probability. Checklist is not met, low probability. Simple. Okay, eliminate luck. There's no luck involved in investing if you have a checklist. There's no luck. You create your luck. A system you can replicate. With a checklist system, you can do it again and again, stock after stock, year after year, and choosing only the best high probability stocks with clarity. Odds are always stacked in your favor. Everything's about probabilities here. Okay, so this is going back to this checklist, guys. I want to really focus on the monthly time frame here, because if the monthly is met, the weekly and the daily will take care of themselves. So what are we looking for? History of trends. If a stock has performed well in the past, it will perform well in the future. Long-term consolidation, breakout from consolidation, start of the next trend, new all-time highs. This is ultimately what I'm looking for, a monthly time frame. And it looks like this. History of performance, sideways market, breakout, and it's this history of trends, long-term consolidation, breakout and start of the next trend. And it's this trend here that will typically last 12 to 24 months. So as I said, if you can find this on the monthly, the weekly and the daily will take care of themselves. So here's some examples. 2022 to 2020, I'm saying question mark because we don't know how long this is going to end or how long it'll go on for. ACGL, US stock has moved 36% in 5 months. Trend, consolidation, breakout trend. This is a UK stock, Burberry, the fashion brand, trend, consolidation, and I've recently added this into my portfolio because it's met my criteria. New stock. 2022 to 2020, I say this now because PCG, Progressive Corporation, trend, consolidation trend. It's moved 33% in 14 months. It's a slower moving stock. Stocks move at different paces. 2021 to now is a question mark. This stock is still in my portfolio. It moved 753% in 7 years. Went through a sideways market, 45% in 14 months. 2020 to 21, 138% in 14 months. This is IDEX Laboratories. You may not have heard of these stocks. It doesn't matter. What counts is the money, not the name. So we got to be neutral to all the ticker symbols. People love Tesla. Tesla doesn't love you guys. You have to love the stock that's paying you. Nothing else. Okay, NVIDIA, you guys will be, this is Microsoft. The reason why I wanted to show this was 31% was the decline during coronavirus. Look at what happened. It was trending before coronavirus. Coronavirus happened. It moved 82% in 17 months. 2018, this is the US dollar Turkish lira, 78% in 6 months. I've gone back to 2017 to 2018. I always hear the same argument. Trends will disappear. I'm in 2017, 2018, 78% in 12 months. This is Marriott, the hotel chain. Trend, consolidation trend. NVIDIA, now everyone's talking about AI. That's why it's starting to move again. But look at the history of NVIDIA. When it was first in my portfolio, 2016 to 2018, came back into my portfolio in 2020. It repeats, trends repeat. You've just got to be able to find them. One more stock, Southwest Airlines, 212% in 15 months. I've gone back to 2014, 2015. I can keep on going back all the way to 2007 when I started. Step 3, consistency in maximizing profit. Now, you need to be an analyst and an investor to make returns. You can't skimp. You can't be a bad analyst. Ultimately, guys, it's the perfect hybrid approach. Looking at charts like a trader, holding your positions like an investor. If you think about it, if you're bad at analyzing and investing, you'll have a poorly performing portfolio. If you're good at one and bad at the other, you'll have an underperforming portfolio. But if you're good at both, you'll achieve those returns I'm talking about, the compound growth. So when an asset on our shortlist, so through that scanning process, when an asset sets up, I take a position. Now I've created tools that do all the work. Entry points, stop losses, risk management, compounding is all based on algorithms that I've back tested and it works. The 86% return, all based on these sort of tools. I take the values, I manually put them into my broker account. There's no pen and paper involved, no guesswork. It's all very mechanical. Now here's what's involved. Entry point, typically 10 or 20% above the bar. Stop loss, ATR and a multiplier. ATR stands for average true range. So I take the personality, how much a stock moves on average, multiply it by a number, and that gives me a stop loss. Risk management, I'm going to show you my specific framework. Compound levels, add more of a winning stock. And your exit management, a trailing stop loss. Every position should have a stop loss. If you don't have a stop loss, you've got 100% of your portfolio at risk. If coronavirus happens, you're in trouble. Have a stop loss. Okay, the strategy must cut losers short and let winners run. So here's my risk management framework, guys. It's when I switch from fearing risk to controlling risk that my performance grew exponentially. This is how I did it. Rule 1, risk per position. Rule 2, risk per day. Rule 3, max risk allocation. Never deviate from these rules. Focus on the downside, let the profit come to us. These are my rules. In new markets, what I mean, emerging trends, I'll be on the lower side of this range. When the markets are in full trend, I'll get more aggressive. So this is typically what it looks like. Let's say I take 5 positions, each one risking 2%, total risk exposure of 10%. Let's say 2 of those are losing positions, that's a 4% loss. One of them's break even, the other 2 return me 10% each over 12 months. That's a total return of 20%. If we take away the loss, that's 16% over 12 months. That's not bad. But let's take our winning positions further. Let's say instead of just holding one position, I start buying more of the winning positions only. And each one returned me 25% over 12 months. So that's 50% in total. Now take away my loss. You can see the difference compound growth will get you. But here's the thing. Sometimes people will ask me, what's your win rate? My win rate doesn't matter. I don't care about my win rate. My win rate is only 40% if you look at it. But my profit is 46% in 12 months. So it's not about winners and losers. It's about profit versus loss. Big, big difference. My risk to reward is 1 to infinity. Let your winning positions run. I don't think in 1 to 1, 1 to 2, 1 to 3, you're limiting your returns. But this is the thing also, guys. All winning positions can happen. All losing positions can happen. It's rare, but it can happen. But generally, what tends to happen is a mixed bag of results each and every round of trend. So as trend followers, we have no idea which stock will be profitable, neither do we care. We are ticker neutral. We don't think in terms of being right. We think in terms of making profit. Finally, optimize your performance with the right broker, unbeatable array of assets, extremely competitive costs. Buy in a bull market, sell in a bear market. You've got to be able to switch in both directions. You've got to have complete risk and exit management capabilities. Protect your portfolio at all times. And here in the UK, well, not here, in the UK, we have spread betting accounts free of capital gains tax. Okay, finally, your investing routine. This is the important thing, guys. Each and every one person has a lifestyle. You're busy. So you want something that's working around your lifestyle, not cramping your style. Day trading cramps your style. Trend following doesn't. It fits around everything. So here's what I do. Scan at the weekend, but I do it every day for my community. Weekend markets are quiet. Sit down in your room, your office, take a couple of hours, get ready for the week ahead. Nice and relaxed. This takes me 1 to 3 hours, depending on market conditions. Monday to Friday, manage my portfolio. Because I've done the hard work at the weekend, Monday to Friday takes me minutes a day. 10, 15 minutes. This is repeatable and sustainable over many, many years. So here's the complete blueprint, guys. Adopt a trend following process that fits around your lifestyle. Calculate your desired ROI, reverse engineer the process. We did that at the very beginning. Invest in stocks outperforming the market. Don't settle for average, exceed average. Establish market conditions using the S&P. Shortlist the best stocks using scanners and tools. Use a checklist system to identify your edge and kills biases. execute a trend following strategy, focus on what is in your control, let go of what isn't. What isn't in our control? The outcome of each and every position. Everything before that is in your control, but you don't know whether that position is going to be a winner or a loser. So you have to focus on what is in your control, not what isn't. Cut losers short, let winners run, and compound, rebalance every 12 to 24 months and repeat. Okay, so your next steps, just to explain a little bit about what we're doing here at Sublime Trading. We've got our Education Academy and we've got the fund management. The education side, we teach you the process. Fund management, people just want to be familiar with it. You guys are already familiar now in 20 minutes with what we're doing. Phoenix, you have support all the way through the process. In the Griffin, we keep you updated with newsletters. Phoenix, we do the scanning for you. In the Griffin, we'll keep you updated with entry and exits through the emails. In the Phoenix, we share our portfolio for you to copy. In the Griffin, you have a portal where you can log in and see the performance. This is based on a subscription model, which is the Phoenix, and the Griffin is based on a high watermark performance model. Ultimately, guys, you'll get the same returns. That's what I'm trying to get at here. The only difference is in the Phoenix, you learn the process. In the Griffin fund, we do it for you. Okay, so to keep the momentum going, just to say thank you to everyone that has attended offline and online. If you go to sublimetrading.io/Pepperstone, we have the ability to speak to me about your portfolio. We deep dive, look at what you're doing, what needs to change. Normally I charge £1,000, but thanks to Wissam, all of these are complimentary. You don't have to pay anything. So go to this link and put in your details, register, calendar pops up, book a call with myself, not my team, with myself. Okay, and then once you arrive on the call, you'll also get the stock market blueprint. We'll also give you my first attempt at a book, guys. It's not live yet, but the whole strategy is at the back as well. I'll give you my first version of this book. 30 days free on TradingView. We'll give you the tools that we've used in this presentation so you can start your analysis. The wealth calculator I used at the very beginning. Another presentation that I did for a bunch of CEOs and high net worth individuals, all 7-figure plus business owners. I'll give you the recording of that as well. Off the back of that recording, we've grown in India, we've grown in Mexico, we've grown in the US. We started scanning the Nifty for our Indian community members. We're doing a lot of great things at Sublime Trading that's not being done out there. And please, there's one thing I'll ask you, please follow me on LinkedIn. You can connect with me on LinkedIn. I'm quite active on LinkedIn, so if you'd like to get in touch with me, please do search for me on LinkedIn and we can take things from there. sublimetrading.io/Pepperstone. Thank you.